We need to think deeper about something. Ever since Dave Ramsey went against the common orthodoxy of the 4% rule in retirement withdrawals, we've seen financial planners come at him from all directions, but is there weight to Dave Ramsey advising a higher withdrawal rate? That's the question I want to explore. Obviously, this is not financial advice, but subscribe to the channel for more discussions like this. Let's get into it.
No, it shouldn't be 4 to 5%. It ought to be more than that. I mean, if you're making 12 in good mutual funds, and the S&P is average 11.8, and if inflation for the last 80 years is average 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So I'm perfectly comfortable drawing 8. But if you want to be a little bit conservative, 7, but sure not 5 or 3.
Apparently, these few sentences were enough to set off an avalanche of criticism against Dave Ramsey, since a lot of financial and retirement plan advisors believed spending that high an amount on your returns was going to put those retirees in jeopardy over the later stage of their retirement, but the math wasn't quite adding up for me, and I think there were some assumptions baked into the whole 4% rule that I'm not sure really apply the same way as they did back in the 90s when it was devised. So let's take a deeper look at this. The median American today, between 54 and 65 years of age, has just over $500,000 in their retirement account, and yet if you ask most of them, they've been led to believe that you need to have saved more than $1.4 million for a comfortable retirement after your 60s. And it's that age where the standard 30-year retirement time frame comes from, given the life expectancy in the country stretches to the late 80s, but retirees in the country are sandwiched between an even more important question, which I believe is at the heart of the entire debate. It's the question of striking the balance between spending below the threshold where they overly erode their principal, while also spending enough of their nest egg doesn't just grow for the sake of it, to the point that they never even get to live the fruits of their life's labor before they pass away. Now that you have those two ends of the spectrum in mind, I want you to imagine the figure of 4% that's traditionally given, and the 8% that Dave Ramsey gave as the two extremes we need to find a middle ground between. And surprisingly enough, that's a really difficult job because there's good arguments on both sides. And most of all, no one wants to end up in a situation where retirees reach their 70s or 80s and run out of money at the worst possible time. Here's where I think this debate needs the input of someone else, and that is William Bengen, who had devised the entire conventional wisdom of the 4% rule back in the 90s. William, in recent years, has come out and conducted more research, especially factoring major world events like the 2008 market crash and the pandemic in 2020. Here's what he had to say during a recent podcast appearance.
That's why I'm not a pessimist. I think if you have a well-diversified portfolio, 4.5% is pretty penurious, pretty cheap. I think 5.5% is doable, even in this environment.
You mentioned the rule being sensitive to the withdrawal period. If we hold that constant and just say, let's talk about a 30-year period, are there scenarios, like we've talked about prices and inflation, are there scenarios where you would say, you know what, under these circumstances, I don't think that the 4% rule does, or the 4.5% rule does actually make sense anymore?
Yeah. I played around with scenarios. I wanted to see what would it take to break the 4% rule or 4.5% rule, wherever you have it. And I came out with one scenario that the retiree encountered double-digit inflation for the first 15 years of retirement, and average returns, and that broke the 4% rule. That knocked it down to about 3.8. That's something we've never experienced. Doesn't mean we won't. That's why I say that the 4% rule is not a rule of nature; it's just a rule of thumb, experiential rule. So it could change, and it's changed in the past. In the 50s, it was not 4.5%, it was 5%. And it came down because of that big inflationary burst in the 70s.
That's a perfect way to put it. It's not a rule of nature, it's a rule of thumb. And in the kind of world that he drafted it in, William Bengen had to be very conservative with his calculations, despite the fact that he was leaving more than ample room to adjust for inflation. He came out recently and revised the rule to 4.7% and then down to 4.5% after seeing the inflation in the last 2 years. But the idea that you can glean here is that while 4% may be too conservative to the point that retirees don't even adequately spend their nest egg, there's a lot of volatility in the world and markets today to justify something like an 8% withdrawal rate, as Dave Ramsey suggests. Remember, the figures that these calculations use are based on historical trends and assumptions. They take an average return of the S&P 500, an average ratio of inflation, and extrapolate that out of the decades. That's something that even financial analyst Peter Grandich was warning about in this conversation with Robert Kiyosaki.
The retirement plans that have been made with 8, 10, 12%
And remember, any number you give means the future of tens of millions of people due for retirement hangs in the balance. That's why it's important to also factor in the age to which people decide to retire. It's because retiring in your 50s or even early 60s can have a significant exponential impact on your withdrawals, your total nest egg value, and then importantly, the rate of return on your portfolio. Dave Ramsey once gave a reason why he believes 4% is so often the default that recommended to retirees on the behalf of financial planners.
We have about $100,000 in Roth and $1 million in traditional IRAs. Our wonderful, I know.
Way to go, Steve.
Our wonderful financial advisor is recommending a distribution of no more than 4%. We're looking at about 5% to enable us to travel while we're able to. What is your recommendation on the maximum annual distribution? It's a great question. And they're in a good spot. And so this makes me feel better about saying, sure, 40,000 versus 50,000 on the distribution is what they're really asking, right? On, let's say, the $1 million in traditional IRAs, that's going to be taxable. Mm-hmm. This doesn't feel like a big portion of their world if they've got, the 140,000 income.
So if the money is invested in good mutual funds and it's making, average market returns of 11%, 12%, why can you only take out 4%?
Just fear, I think, is the main reason people do it.
Why
Inflation.
Would the financial advisor say that?
He gets more money? Is that how that works?
Possibly. Or possibly he is a financial planning lemming. You know what a lemming is?
That's an old school word.
These are small rats that run in herds and follow each other over cliffs.
That is the funniest way I've heard to describe financial advisors.
And so, meaning you go along with the crowd. You go along with the crowd. You go along with the crowd. And you don't even ask why. You just go along with the crowd. And so you don't want to be sheeple. So here's the thing. That is a standard thing in financial planning, 4%. Because after inflation and after poor rates of return on the portfolio, you're still going to be okay at 4%. But by God, 5%, you're going to sink it. Which is completely asinine. This is ridiculous.
Whatever conclusion that you can come to, I think this entire conversation should tell you that there's a lot more nuance to consider when making one of the most important decisions about your retirement, and that means neither end of the extreme is going to work for you, especially since retirees spend decades of their working life to be able to afford a comfortable retirement of living a good life on the back of their hard work. Let me know in the comments how you approach this subject, because I think the more voices we have contributing to this debate, the better it is for people trying to make that decision in their life.